Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Airbnb stock. This one came in by request down in the comment section of one of my other videos. If you have a request, put it down in the comments. I'll get the ticker on the whiteboard behind me. Eventually, I will make a video for you. As always, this is not individual investing advice. This is just how I analyze stocks. So a lot of times you'll see me making videos on here where stocks have fallen a lot, and then I'm posting whether we should buy them or not. But Airbnb, fortunately, is a different story. It was up almost 15% on Friday after reporting earnings. I am long this one. We bought it in the Cyclical Investors Club, let's see, back in May of 2022. So all the way back, was it all the way back here? Holy smokes. I had this one a long time. I haven't really been watching it super closely. Yeah, so right around here, I think. Was it 2022 or 2023? I think it was 2022. Yeah, that's about right, because I have it written down. We're up about 35%. So just bought this one as part of my buy and hold growth strategy. As you can see, back the time we bought it, earnings growth was just taking off. And the idea was you buy this one and you hold on to it for a long time. Now, it's a pretty big company. Let me see what the market cap is. $100 billion now. So it's not going to have the same kind of growth potential that a smaller company would have. But one of the things I liked about it, other than just the basic numbers, which is usually what kind of spurs, like I want those to work, they need to work. But because they were bigger, one of the things I like about them, I just think they have structural advantages compared to hotels when it comes to long-term stays, like longer than, say, 3 days, like a long weekend. Then Airbnb starts looking really attractive. And I also think that they're cheaper, they're more interesting, they're more flexible. And if we ever have kind of economic weakness, I figured that sure, their business would be hurt, but if you look at what like a Hilton or a Marriott stock is trading at now, I thought that Airbnb just had structural advantages, and they only really have one competitor, like one main competitor in Vrbo. So that was kind of what pushed me over the edge, even though they were a pretty big company, to go ahead and buy it. I thought maybe they could get like 15% growth over the long term. Now, so let's look at the numbers now. I'm going to use the earnings time until payback method here. And the good thing is we kind of had this bump, kind of the post-COVID travel boom bump, and now we have a year where it has gone back to normal. So we had a boom. I think we've had the bust, at least from that period, and now we're going to see we have this new baseline, and we're going to see how much they can grow off that baseline. So the market liked what earnings did, probably maybe thinking that this may be a baseline bottom, like I'm saying, rather than keeping it go down. Now, obviously, if there's a recession or something like that, or there's external issues that come up, earnings could fall next year. But from the pandemic boom bust, from that travel bust, or at least coming off the boom, that part is probably worked itself through, right? So we can kind of look at earnings now, I think, and draw some projections. The PE right now is 39, so that's pretty high. So they're going to have to have earnings grow pretty fast for a decently long period of time in order to justify that valuation. But we'll look at that. The main thing I want to talk about here is what earnings growth rate to use. So we're going to have our initial earnings, which are going to be pretty low because it trades at a 38 PE. Don't know what the earnings yield here is. They have a 2.57% earnings yield. I will probably be pulling forward this year's earnings, so mine might be a little better when we look at it in the spreadsheet. But that's pretty low, right? If so, they need to grow earnings pretty well after that in order to justify that. Now, analysts think they're going to grow 14% and 20% in the years after that. The estimate I'm going to use as a long-term earnings growth rate is 12%. I think they have a pretty good just base in terms of any kind of like inflation and just normal earnings growth, more efficiencies and things. But they can also go into other businesses and expand on the platform that they have too. So I think 12% earnings growth over the long term from here is very reasonable, and that's what I'm going to use in this analysis. So that's actually more conservative than, like a lot more conservative than analysts, but I don't think, what is their average here, 16% or 17%? That just seems too much to maintain over the long term without something good happening. The good thing about these businesses, sometimes they kind of strike gold or whatever when you might not expect it. But we have to kind of play the odds and try to get the averages on our side. So 12% is what I'm using. Okay, yeah. So I have a 2.95% earnings growth rate, earnings yield, instead of that 2.57, which is what Fastgraphs have, because I'm pulling forward next year's earnings. And then I'm going to assume those grow at 12% per year. So if you bought the whole business for $100, you'd earn $2.95 that first year plus 12% growth, right? So I'll show you what that looks like real quick. So here we have the $2.95, and then if you get that 12% growth, you'd earn $3.31 on your $100 investment the first year, and then the next year you'd earn $3.71, and so on. You want to collect those until you collect $100. So let's see how long it would take. It would take 14 years in order to do that. So in order for something to be a buy, I want that to be about 10 years. The market right now's average is about 15 years. So I would say it's right in line with even after this bump with the stock price, it's right in line kind of with where the market is right now. In order to become a buy, I didn't actually calculate that ahead of time, but we can try some numbers here. I'm going to say maybe 90. 90 would be a buy, but let's see. Man, I might have got it right on. About $93 a share is what you'd be looking at. So if it falls to $93 and within the next 6 months or so, without any kind of horrible negative news, 6 or 9 months, because I'm pulling forward this next year's earnings, so this will probably stay the same unless there's like some bad news or good news or something. So yeah, I mean, mark that kind of rough $100 mark maybe on the pegboard. Keep an eye on it, and I think if it gets down there, then it's a reasonable long-term buy. What I like about it is you can buy it and not really pay too much attention to it. It's not try to trade it. You really are betting on their structural advantages that they have as a business over the very long term. And if you can buy that at a discount, then you should be able to do, pretty well. So I bought it a little less than 3 years ago. So yeah, I mean, I've actually made about that 10 to 12% a year right now. The market's been better than that, but they're still trading at a pretty reasonable price. And I wasn't sure when I bought it how this earnings growth was ultimately going to pan out. I figured it would probably cool off like it did, but it wasn't super expensive once you looked at I think right here it was at an 18, right? So the multiple is compressed over time, even from here to these lower earnings. So it's all just kind of a guess and a bet on 2 or 3 years out, kind of how things are going to look. Okay, if you found this useful, hit the like and subscribe button. I have a free tier over on Patreon. I have a $25 a week weekly picks tier. So check those out. The links are in the description. If you have a request, let me know, and I'll see everybody later.